fellows, welcome back. We are extremely lucky to have with us Greg Ip, who is the Chief Economics Commentator and Deputy Economics Editor for the Wall Street Journal. Greg, you should know that when our last session was with Maya McGinnis, and when she heard that you were the next speaker, she exclaimed how wonderful you are.
Oh, that was very nice of her. Yeah, well, I lean heavily on her and her committee's work to help inform my own work. So yes, she's a great guest. Hope she was informative and entertaining.
Yes, she was. So Greg writes about U.S. and global economic developments and policy in his Capital Account column and in Real-Time Economics. He previously was a U.S. economics editor for The Economist, and before that he was at the Journal, then at The Economist, then back at the Journal. He's also the author of the Little Book of Economics: How the Economy Works in the Real World, and Foolproof: Why Safety Can Be Dangerous and How Danger Makes Us Safe. And so I've asked Greg to come talk about some big macroeconomic issues, trends that people should be aware of, if it's something you are covering now or something you may cover. He's going to talk through some of those main points, and then he'll have time for questions. So Greg, welcome, and I'll turn it over to you.
Thanks very much, and thanks for having me. It's a terrific program, Chris, that you run here. It's always an honor to speak to your fellows. I gather all of you are probably working in business, finance, economics, or hope to in some sort of way. Well, economics is a pretty sprawling area. I've been doing it now in one way, shape, or form for 25 years. And I think it's really interesting, and I've learned a lot along the way. And what I've tried to do today is I'm going to give you a brief presentation, 25 minutes, with some slides, to lay out for you what I think are the 5 or 6 really, really big economic issues going on in the world today, the ones that I and my colleagues here at the Journal are focusing a lot of our thinking and reporting and research on, and looking for new ideas and always trying to iterate the next line forward in the story. And what I'll try and do along the way is share with you some of the basic foundational economic concepts that we use to think about these issues, all of which hopefully will be useful to you. You don't have to be an economist to write about economics, but it helps to understand how economists think. So that's what I hope to touch on today. And then at the end of that, you'll be free to ask me any questions you wish. So I'm going to start by, I have a presentation here. I'm going to be flipping back and forth between it and the regular audio. So the first job of the economics team is to tell readers what's going on in the economy. Where are we today? Where is unemployment? Where is the economy? Is it growing? Is it shrinking? Is it speeding up? Is it slowing down? Are we in a recession? Are we in expansion? Last year or two have obviously been extremely tumultuous that way. Next to COVID itself, the economic impact of COVID has probably been the single biggest story affecting people's ordinary lives, and that's what we here at the Journal are writing on. So,
Greg, did you want to be showing the slides right now? Slides are not.
Yeah, I'm about to share the screen.
Okay, I'm sorry, didn't mean to interrupt.
That's okay. Now, where is it? There we go. Okay. So we think of the economy grows over time. Gross domestic product is essentially the value of all goods and services in the economy. And typically we think of GDP growing over time in a fairly steady path, which is largely a function of 3 things. How many workers do you have? How productive are those workers? And how much more information and technology and innovation do we bring to the table to make people even more productive every given year? What's fascinating about what happened in the last year is a big contrast with what happened in the previous recession. So if you look at the first of the 2 pictures on this slide, you can sort of see the orange line is what the Congressional Budget Office thought GDP would be before the global financial crisis hit. And the blue line is what actually happened. So you can see we went into a deep recession in the years 2008, 2009. And then we started growing again, but we grew very slowly. And we never actually got back to the path we were on before. So this tells you about 2 of the consequences of recessions. One is that in the first initial period, we become poorer because people lose their jobs and their salaries go down. But even after the recession ends and economic activity begins growing again, there's still that sort of foregone incomes and those foregone jobs, all those people struggling to find new jobs, maybe people who dropped out of the labor force. And that's kind of a really major cost to us because it's income that's lost forever that we never get back. The story of the latest recession is very different if you look at the second picture I have here. Now, once again, the orange line is what the Congressional Budget Office thought we were going to be doing before the recession, actually, before the pandemic came along. And the blue line is where we are so far. And there's a bit of a dotted line to show you what the last forecast was when the Wall Street Journal surveyed economists. As you can see, it's been quite a remarkable difference from the last time. We had a very big drop, a very rapid comeback, and then we've continued to grow back. And it looks like if we're lucky, we'll get through this period and get all the way back to the path that we were on even before this. And this is fortunate because even though there was a lot of enormous economic harm and devastation from the pandemic, it looks like we will escape some of the worst long-lasting losses, the enormous costs that are imposed from people who go on for years and years without being able to find a job or not being able to find a job that has really lived up to what they're capable of doing. There are a lot of reasons for that. I'd say that's probably the main reason for that is that the pandemic is a very different type of beast than the global financial crisis. The global financial crisis was essentially the world or financial markets waking up to the idea that we had borrowed a lot of money and invested in things that just weren't very valuable, like houses that weren't worth as much as we thought they were. Whereas what happened with the pandemic was essentially it hit an economy that was fundamentally quite healthy and sound, and people just weren't able to work because it was not safe to do so. And in that sense, it was like a natural disaster, like a hurricane. And so we know that when hurricanes are over, economic activity usually bounces back very quickly. And that's precisely what happened when the initial round of restrictions were lifted. The economy bounced back very quickly. Now, this was no ordinary disaster. It was like a hurricane that hit the entire country and has lasted about a year. But most of the restrictions have since lifted off, and people are slowly getting back into their old way of life. And that's one of the reasons why we've been able to come back. But we also had very, very aggressive action by monetary and fiscal policy to try and pull the economy back, in some sense informed by the very sort of like less than satisfactory outcome that we had back in the last recession. Now, as you know, there's a new wave of the virus crossing the country, the Delta variant, and we've had some evidence that it's making people a little bit more reluctant. But I don't think it'll be as bad on the economy as it was a year or two ago. And that's because of the nature of the way people adjust to new risks. And this is part of the things that have come out of my research that went into one of my books. When a risk is new and novel, people are really scared. And so even without the restrictions that were imposed 2 years ago, people would have stayed home just to avoid getting sick. Well, we are a year and a half later. People are more familiar with the risk. A lot of us are vaccinated, so we're not quite as scared of it. Governments are much more reluctant to impose restrictions. And so we're now on our third wave of the virus. And you can see that each wave has had a smaller impact on the economy than it did before. And that just speaks to the adaptability of human beings, even in the face of something as new and dangerous as the COVID virus. And it's my view and the view of most economists that the Delta variant, while it will cause a few disruptions, it will not push the economy back to recession or fundamentally derail the recovery that we have going on. Now, so now I'm going to talk a little bit about, that was the GDP, which is, the value of goods and services. Next, I want to talk a little bit about what's been happening in labor markets over the course of that, because in our reporting, people are fundamentally very, very concerned with what happens to jobs in periods like this. So let's take a look. So the blue line is the number of people unemployed. And that great big spike you saw last year was when all the restrictions came and everybody had to basically stop working. And the big drop was as those restrictions came off. And as you can see, the number of people unemployed has been steadily trending down, down, down. And it's actually very impressive. We now have fewer people who are officially unemployed, approximately half the level than we did at the peak of the prior recession. What's even more fascinating is that the orange line is the number of job vacancies. So we have a situation today where the unemployment rate is still a little bit elevated at around 5.5%. It was 3.5% before the pandemic began. And so that would ordinarily tell you that we have a problem where the economy is weak and so employers just don't demand as many workers. But the fact of the matter is that employers do want workers, they just can't fill them. So that tells you that we're facing a situation in the economy which is very unfamiliar to us when we come out of recession. Ordinarily, the problem you're dealing with at a time like now is lack of demand. Lack of demand for goods and services, lack of demand for workers to provide those goods and services. Today, it seems to be a lack of supply. We've all heard of the shortages of things like semiconductors, which are reducing the supply of cars if you want to go and shop for a car, the shortage of containers crossing the ocean. So if you want to import goods to make bicycles or hot tubs, those things are in short supply. If you want to buy a sofa, you have to wait 6 months, that sort of thing. We have shortages of goods and we have shortages of workers, restaurants that can't open 7 days a week or have the entire dining room open because they can't find workers to fill those spots. And exactly why there are shortages of workers is a matter of debate right now, but we think there are three broad reasons. One is that people are still afraid of the virus, so they don't want to go to jobs where they're going to be exposed. One is that, well, there was until a week or two ago, very generous unemployment insurance, so maybe it wasn't worthwhile to go back to work. A third was that a lot of workers had small children who weren't able to go to daycare or school, so the parents had to stay home with those children. And I think another possibility that we're all exploring right now is that people in the last year have fundamentally changed their minds about what they want to do for a living. And so they've gone to look at the different things and they're not available to go back to work in that hotel or to work in the airport or to work in the restaurant. And so we have this great big sort of like reshuffling going on in the labor market. It could be a while before we work our way through it. Now, one of the interesting consequences of this unusual lack of supply of workers is the impact on wages. Now, if you go back to this period, the last recession around 2008, you see what normally happens in a recession is that unemployment goes up, demand for workers goes down. And so it's much harder for a worker to get a wage increase because there just aren't that many jobs available and employers are trying to cut costs. That's not what's happening right now. If you pay close attention to the green line, which is at the top on to the right, that represents the wage growth of the 25% lowest paid workers. And it's fascinating to see that whereas that group was so hard hit after the last recession because demand for low-skilled work really dried up, the opposite is going on right now. There's a huge demand for these types of workers, but as I was discussing a minute ago, a lot of them just aren't showing up and don't seem to be interested in taking those jobs. So you're seeing very strong wage growth in the 4% area, which is the strongest we've seen in over a decade for this group of workers. Once again, completely different from the pattern that we are used to. Let's go on to the policy discussion now. When I first came to Washington, which was all the way back in 2001, and Chris and I were colleagues in the Washington Bureau at the time, my job was to cover the Federal Reserve. Most of you have heard of the Federal Reserve. That's America's central bank. And its job is to essentially govern financial conditions, primarily interest rates, to make sure the economy is on an even keel all the time. They essentially want to guard against inflation being too high or unemployment being too high. They want unemployment low and stable, and they want inflation low and stable. And so essentially they are the primary, the first responder to recessionary impacts. They respond usually by cutting interest rates when recessions happen. Well, in the last decade or two, though, things have gotten a little funky because what the Federal Reserve discovered is that when it came into the recession the last time around, interest rates were already kind of low at around 5%. They came all the way down to 0, and that still wasn't enough to get the economy out of the soup. And you'll get a sense of what I'm talking about when I go back to my PowerPoint here and show it to you. Let me just share this with you once again, and I'm going to go to the next chart. Now, the blue line is the federal funds rate. That's the short-term interest rate that the Fed controls that most of us are familiar with. They're going to have a meeting this week. There'll be news about that. Now, as you can see, they had to cut it all the way to close to 0 after the last recession to try and get us out of the soup. And even 6 years later, they still had, it took them 6 years to start to raise it again. Before the pandemic had hit, they had only got it back up to 2.5%. Why did they only get it up to 2.5%? Well, for a variety of structural reasons, the economy just didn't seem to be as strong as it used to be. Inflation wasn't as high as it used to be. And so interest rates couldn't go as high as they used to. The economy, in some sense, started to keel over when interest rates got to levels that used to be really quite normal. So we're in this sort of like, we're in this environment where interest rates just couldn't go very high without severely weakening the economy. And that was kind of a puzzle that has bothered the Fed for some time. The pandemic hits, immediately the Fed lowers interest rates once again to 0. But as we saw, the economy is in a very big hole. The unemployment rate has shot up. And so the Fed decided, well, we have to do something else. So with short-term interest rates at 0, they decided to try and adjust other aspects of the financial markets. So one of the things they did was they started going out and buying government bonds. Now, when you buy bonds, the price goes up. And if you follow financial markets, when the price of a bond goes up, the yield goes down. And treasury bond yields, like on the 10-year treasury bond yield, they help influence things like mortgages. That makes houses more affordable. The other thing the Fed did was they went out and they bought corporate bonds. They lent to municipalities. They often lend money to companies. This is not normally what the Federal Reserve does, but they decided that in desperate times, call for desperate measures. And since the Fed can basically lend as much money as it wants just by printing the money, it would do this to try and help the economy along. And that's why you see this red line, which is really all the assets that the Federal Reserve has, shooting up from basically around, shooting up from about $500 billion before the last recession to $2 trillion, and then eventually up to $3 trillion. And then finding its way in this last cycle all the way up to like $8 trillion. So the Federal Reserve has basically pushed into areas that it's never been before, and that's very controversial. And it's right now trying to decide whether it can start to extract itself from that.
Hey,
we can talk more about that later. Yeah.
If I could ask a question, the red line, I mean, it shoots up during the Great Recession, and then it kind of continues to kind of ease up in 2012, 2013, 14. Why was it going up still then? I mean, wasn't the economy recovering at that time?
Yeah, correct. But the unemployment rate is still high, inflation was still low. And so the Federal Reserve decided that it's not enough for the economy to be growing. We want it to grow even faster to try and accelerate the return of unemployment back down to some low, stable level, like 4%. At the time, unemployment was like 7%. That was unacceptable. And they were also concerned about the fact that inflation seemed to be stubbornly low, below 2%, which is what they considered their target level. And so they kept stimulating the economy in an effort to try and like get demand up higher and try and make more progress getting unemployment down faster. They didn't really feel satisfied till around the year 2017 when they started to like sell off some of those bonds and shrink their balance sheet. But as you can see, they didn't get very far when the pandemic hit, and they had to start the whole process up again.
Okay, thanks.
Let's see, where are we time-wise? We're at 3:16. Okay. So that takes us to the next question. Well, so the whole premise of what the Fed was doing was, well, it's okay for us to be really stimulative for lower interest rates a lot, because after all, as I was just saying a minute ago, inflation is low. It's not only low, it's actually too low. You know, the light blue line is the inflation rate, and the solid blue line is if we take out food and energy, the so-called core rate, which is a little less volatile. And as you can see, this number coming into the recession was stuck around 2%. In fact, a lot of the times the Fed has a different inflation measure, which was even lower. And so the Fed was saying, well, golly, we don't want inflation to go too low or stay too low for too long. If people get used to this, then it'll stay stuck there because expectations of inflation tend to be self-fulfilling. So they said, we're going to take this opportunity to try and really push hard and get inflation actually above 2%. The theory being that if you have a period of low inflation followed by, if you have a period of inflation below 2% for a while, and then you allow it to go above 2% for a while, that averages out to 2%. And if people are convinced the Fed will always get inflation back to an average of 2%, then they will behave accordingly. They won't start setting wages and prices so low that you go to lower and lower inflation levels and eventually hit a zero or a negative number. Be careful what you ask for, because you just might get it. As you can see, what happened as we came out of the pandemic and the economy came back to life, inflation shot up to around the 4 or 5% level. Now, what's going on here? You could think of there being two types of inflation: demand pull and supply push. When I talk about demand pull, that's what I mean is that there's so much spending, there's just really too much demand chasing a finite supply of goods and services. And that's what we would call an overheating economy. And that's the inflation the Fed typically deals with. So when it sees the unemployment rate going down and down and down and lots of spending and people feeling really good, they say, well, you know, maybe we want to raise interest rates a little bit, slow that spending down so that it doesn't get ahead of the ability of the economy to supply goods and services. Don't want to run out of business capacity. Don't want to run out of workers. And that's kind of what they thought was going to happen as we came into this pandemic. But instead, what we got was a full-on dosage of what I call supply-side inflation. And supply-side inflation happens when the supply of goods and services is constricted. Now, this used to happen fairly often in the oil markets, right? We would perhaps have a war in the Middle East, or there would be a hurricane that would knock out oil rigs in the Gulf of Mexico, or there would be some huge boom in China, which would suddenly, you know, all the oil would suddenly go to China and there wouldn't be enough here. You have a big spike in the price of oil. And here in the United States, that would be seen as really bad, because it's not like everybody here wants, you know, is spending a lot of money and that's driving up the price of oil. No, it's like a tax. Everybody suddenly has to pay more for their oil. Well, what we're going through right now is almost like 5 or 10 little oil shocks all at once. So we have these shortages of semiconductors. That causes the shortage of new cars. The shortage of new cars causes the shortage of used cars. So the prices of cars are going up. There are shortages of long-haul truckers and truck space and space on containers. And therefore, the cost of getting storage of anything crossing the ocean is going up. We've read about shortages of natural gas now in Great Britain. There are shortages of chicken wings, so the price of chicken wings is going up. And as I mentioned, there are shortages of workers, so the price of a restaurant meal is going up. So all of this is hitting the economy at once. We are not used to seeing inflation go up when unemployment is still rather elevated. And that's kind of the dilemma we're in right now. We are not confronting traditional demand-driven inflation. We're confronting supply inflation driven by a constriction in supply. And there's some demand layered over that, because if you recall, the federal government sent out a bunch of checks to people and they're out spending that money, and that's tending to goose demand as well. Let's talk very quickly about fiscal policy. So the other tool we have to manage the economy is fiscal policy, which is basically taxing, spending, and borrowing. And that's what we're going to take a look at in our next spreadsheet. And we're going to go to fiscal policy. All right. So the blue line here is the debt to GDP ratio, and that's the number you hear on the left side of the screen. So as you can see, after the last crisis in 2008, the debt to GDP ratio went up a lot. And that's because the debt went up as we borrowed and the GDP went down because we were in a recession. And exactly the same thing happened this past time, although this time we took an even much more aggressive approach to this recession than we did the last one. Now, you recall what that my very first chart that showed how slow GDP was to recover to the old path it was on. Well, one of the things Congress and the Federal Reserve decided this time around is let's not have that slow recovery again. Let's borrow as much as it takes to get the economy growing again. So instead of borrowing $2 trillion like last time, they borrowed $5 trillion. And this basically boosted the debt to GDP ratio by 20 percentage points. Now, the debt, as you probably know, is the sum of all the deficits that we've borrowed, all the money we've borrowed in the past. The annual amount of borrowing is called the deficit, and that's the red line there. The deficit number, as you can see right here, which is the line, the scale on the right, is very large. It got down to like 13% of GDP, all-time largest deficits we've run since the Second World War. Now, we expect that number to like go back up to shrink somewhat next year, because we're not going to repeat all that stimulus. And the question we have to ask is, well, we borrowed all this money, just how risky is it? We've seen the benefit of borrowing all that money. We put out these paycheck protection programs so that small businesses didn't have to cut their employees. We had stimulus checks. We had more generous unemployment insurance. And so that obviously had the benefit of getting the economy back on track faster, but now, we've got this big bill. We've borrowed $4 trillion. How much should we worry about it? Well, the reason people aren't too worried about it is that even as we were borrowing all this money, interest rates were going down, as you remember from one of my previous charts. In fact, they're close to zero. So effectively, we're borrowing money for free. We took on all this debt, and it's not adding much of a burden. And really, that's what you want to think about when you're trying to decide just how sustainable the debts are that we have. How much interest can you expect to pay on them on a given year? And even though debts are very high, the interest that we're paying on that debt is actually very close to its historical average. The big question going forward is, will interest rates stay as low as they are today? Or if they go, are they going to go up? Are they going to go up a lot? Because if they go up a lot, then the cost of that debt is going to quite quickly become quite damaging. I mean, we're going to have to have either very large deficits, or we're going to have to either cut spending or raise taxes to meet all those interest bills. And that will partly depend on that question we talked about earlier. The inflation rate, as we said, is all up to 5%. The Federal Reserve is fairly sure that this is temporary. We talked about all those shortages. They think those shortages are going to go away in the next year or two as the pandemic sort of recedes and, demand kind of falls back to where it was. We're not going to be out there buying all these laptops for kids to go to remote school and so forth, and things will kind of get back to normal. And when that happens, inflation will fall back to 2%. And that's more or less what the financial markets seem to think, and it's more or less what investors think, what economists think. But you don't want to lose sight of the possibility that people could kind of get used to this higher inflation. They say, hey, inflation is 5%, my wage should go up 5%. And the employer is going to say, yeah, you're right, I should pay you 5% more because after all, I can pass it on as prices. And next thing you know, you have this wage price spiral. And if you have that wage price spiral, then the Federal Reserve may have to respond by raising interest rates. And all that debt we took on becomes quite a bit more onerous. So that pretty much wraps it up for the state of the economy and the policy response to it. Those are the sorts of things that we're covering on a virtually daily basis at the Journal, the sorts of issues that you'll probably have to deal with if you're ever assigned to write about the economy. Let me talk very quickly about some of the big picture issues that we're dealing with now that come as a consequence of this. So I said at the very beginning that the economy grows over time based on how many people are working and how productive they are, how much fancy technology they have to work with. And then around that long-term trend, we have recessions and we have booms. But over time, how wealthy we're going to be in 10 to 20 years, that isn't going to really depend on how low interest rates are. It's not really going to depend on how much the government borrowed this year. It'll depend on, just how smart Americans and business and workers are about coming up with new, more efficient ways of doing things. How productive will they be? How many more meals can they serve with one waiter? How many more cars can they make with a given number of workers in one factory? How many more buildings and hotel rooms can be cleaned with the same number of hours of employees? These are, how many newspapers can the Wall Street Journal publish? How many customers, subscribers can we support without having to hire more reporters? That is essentially the story of productivity. It's why we have, we used to require half the people in this country to work on farms to feed ourselves. Now just 2% of the country works on farms, and they feed all of us, plus they manage to export a lot of that stuff. And that's the story of productivity. So productivity is a very important long-term issue. Let's take a quick look at what I think is happening with productivity. Well, one of the things that happened over the course of this recession was that we learned how to do a lot of things remotely that we used to do in person. So for example, if you weren't on Amazon, if you weren't shopping using e-commerce before, you sure are now. I'm doing this interview over a Zoom call instead of like having to get into my car and drive down to meet with you. There are a lot of trips I no longer have to take because I can do them by Zoom. There are classes and doctor visits that all can be done remotely. And all the companies who are trying to figure out these new ways to serve people, like are out there buying new software, trying to invest in their electronic storefronts and their video conferencing and their artificial intelligence, trying to figure out ways they're discovering that the pandemic essentially accelerated the adoption of a lot of technologies, new ways of doing business that we were probably going to do anyway. And the chart that you see here is the footprint of this digitization revolution. That bottom line is the money tells you the percentage change in investment in buildings and factories and so forth. And that has gone down a lot. No big surprise. Probably not going to need as much, expensive office space in Manhattan or downtown Washington going forward if people are going to be working remotely. The top line is the investment in software. Again, no surprise. That's all the money we're spending on Zoom teleconferencing. All the money retailers are spending on their e-commerce storefronts and so forth. And in some ways, we might come out of this process with, higher standards of living in some way. And that's a good thing because over time, that's the fundamental key to enabling our dollars to go further as consumers and to get paid more because, employers have found ways to use all their labor more productively. You go to a restaurant now, and if you want to order out, you'll probably call up and then, you want to order a Domino's pizza. You don't have to walk into the pizza joint to get your pizza. You just, text them and they walk out and they drop it in their trunk. You can track the pizza delivery person as they come to your house and they'll leave it on your front step. You'll pay using like an app in your phone. You never have to have that personal contact. You avoid COVID, you get your pizza faster. Domino's gets to deliver more pizzas more quickly. And hey, they get to pay their pizza delivery people more money. So that's kind of like one of the big picture things that's going on right now. The final big picture thing I want to talk about, which is timely this week, because you may have heard that there's been sort of convulsive news out of China, is that China had a very good crisis. They got control of this virus much faster and their economy didn't shut down as fast. And so this chart shows you that China, for most of the post-war period, the United States was far and away the largest economy in the world. Well, starting with China's economic reforms in the late 1980s and 1990s, they started catching up. And because our economy took such a punch in the chest in the last year, and their economy is doing so well, they're quickly closing that gap. And in 5 or 6 years, they could be the largest economy in the world. Now it raises lots of interesting issues about who's going to be the largest geopolitical power, whose political philosophy will guide the rest of the world, who's going to be the leader of the free world going forward. So that's it for the shared presentation. I'm going to turn this off now. Very quick, that was a very quick tour through the big issues that my colleagues and I are working on. And I guess we have now about 15 minutes, Chris, and I'm happy to entertain any questions or thoughts or comments any of you have on the stuff that we've talked about, that I've just talked about.
Any questions from the fellows to start? Riley. and tell them where you're from.
Yeah, thank you so much for talking to us. I cover the auto industry and politics that affect the auto industry for the Detroit News. And I think that the issue that you just touched on is a really big issue on my beat right now. There's this, big talk in Washington about reshoring the supply chain for autos in particular. And there's a lot of sort of electronics supply chains that impact the industry. I'd be curious to get your take. I know it seems to be sort of the dominant narrative that reshoring the supply chain would be like good for the US economy and for the auto industry in particular, but I know not like all economists feel that way. Would be interested in your thoughts, or if there's things that I should be paying attention to on my beat related to that.
Well, I would say that like up until about 10 years ago, there was consensus among economists that globalization was a good thing. That essentially, like if you go back and study the work of the British economist David Ricardo 200 years ago, he basically said that free trade meant countries could specialize in things that they were good at. So if China was like really good at like labor intensive production, and we were good at high end design, it made sense for us to like design the cars and the computers and for China to design those parts and so forth. There's been a big rethink though about whether we went too far in the direction of maximal efficiency and globalization and supply chains. For one thing, a lot of those jobs that were offshore to other countries where labor was cheaper, they were good jobs. And a lot of communities around Detroit, for example, have suffered a lot. We know that that's had health consequences. We've known that's had family structure consequences. There are a lot of people who have never attained their old standard of living, and it's had political consequences. There's a lot of evidence that the dismay at the loss of those good middle-class blue-collar jobs was one of the reasons Donald Trump was elected in 2016. And now, just in the last few years, we've seen other consequences of it. There's an awareness that China could one day be a geopolitical adversary of ours and could use its control of vital supplies to basically hurt American industry. And indeed, China has very shrewdly persuaded many American companies, including all the big auto companies, to transplant some of their know-how over to China, so that no longer is General Motors just making cars in China. It is now competing against the same people that it one day trained to make cars. And so there's a lot of thinking, well, maybe that wasn't the best long-term strategy. And then just with things like COVID, things like trade wars, and things like climate-related things shutting down power plants and so forth, there's a greater awareness that this finely tuned integrated supply chain is highly vulnerable to like failure to a single link in that chain. All of this has meant that the old vision that we should have as much specializing and outsourcing as possible is not optimal. It may seem optimal for a single company, that supply chain. It's not good for us as a society. But I think what we've also discovered is that trying to basically close that Pandora's box is really hard. Once you've actually moved all that activity overseas, it's really hard to bring it back. It turns out that a lot of things really are made cheaply in China, that if you want to make phones, for example, like all the, there's like, I don't know how many thousand parts that go into an iPhone, and a lot of them are all available within a few miles of each other, Shenzhen in southern China. It turns out that if you want to make electric vehicle batteries in the United States, you need access to a supply of lithium or cobalt. And it turns out that China refines most of the world's lithium and cobalt. So this process has proceeded so far, it's very difficult to know how to undo it. And like I said a minute ago, there's a real shortage of labor going on. Companies, in fact, even before COVID had hit, companies had tried to reshore production of computers, like Motorola tried to assemble a phone in Texas. They couldn't find workers to work in those factories at the salaries that made it sensible for Google to make phones here. So what we're discovering is that while for various political and strategic reasons, we would love to bring a lot of that stuff back to the United States, there seem to be a lot of practical obstacles in the way. One of the expressions you hear a lot of these days is not necessarily onshoring, but friend sourcing or nearshoring, which means that maybe we don't have to have all elements of the car supply chain or the pharmaceutical supply chain or the semiconductor supply chain in the United States, but it would be good to have most of it in countries that are friendly to the United States so that we don't have to worry about a deterioration of relations with China suddenly costing us access to the most vital components in industry today.
The chart you were showing us about the mismatch between workers and job openings. There's more job openings than there are available workers.
Unemployed people, right? Yeah. Yeah.
How unusual is that in history? And is a mismatch today mostly because of geography? It's like the openings are in the Dakotas and people live elsewhere, or is it because of skills?
It's not that unusual in history. We have seen the number of vacancies exceed the number of the unemployed. However, that has normally happened late in the business cycle, and the unemployment rate has been declining for many years. So, for example, this was the case in 2016, 2017. It's very unusual to see it when we're really just barely a year out of the recession. So that just speaks to, again, how unusual the dynamics are. And boy, I wish I could answer that question about what's causing it, but the mismatch question, I think, is a really big deal. So just to give you one example, if you go down to downtown Washington, as I did to my office last week, there are no office workers going to all those restaurants for lunch any longer. So so all those restaurants, all the demand for lunch has shifted from downtown Washington to someplace else. But the restaurants haven't moved to someplace else, and the people who work there haven't moved to someplace else. Moreover, a lot of those workers who were laid off a year ago had no prospect of getting a job back in 2 or 3 months, so they went and found something else to do. Amazon has been hiring about 10 to 20,000 people a month, and the jobs pay reasonably well compared to, say, restaurants. So you'll hear a lot of places complain that they can't hire because there's a fulfillment center from Amazon or UPS or Target opening up a few miles away, and they can't pay the same salaries. So there's just enormous, across many dimensions, there's big mismatches going on. There's mismatches of geography. The unemployed workers are not in the zip codes where the jobs are. There's mismatches of skill type. The jobs you need to work in a fulfillment center are not the same jobs you need to work in a store or a restaurant. And there's mismatches of aspirations. The things people want to do with their lives are not the same things that employers are looking to fill right now.
And another question, I was hoping you could talk a little bit about sourcing. I mean, I noticed on your slides, many of your slides are sourced to Fred. Tell us who Fred is, and tell us if you could be covering economic issues like this. What are the main data sources you go to, and what are the main human sources you go to?
Sure. Okay. Well, I can even show you if you want. I can sort of share my screen again. All right. How's that?
Okay. Yeah. Now we're seeing Fred.
Yeah. Okay. So I just So I just pulled up CPI. If I want to say pull up core CPI, it very quickly figures out this is what I want, and it pulls up the CPI excluding food and energy. And if I want to say, well, let's look at that as a year-over-year percent change, I just do this, and it quickly converts it. And so you can learn all the basics of doing this in an hour. And this is amazing because when I started in the business, this data was really hard to get, and I would literally spend hours, sometimes days, putting a chart together like this. Now you can do it in minutes. There are other places you can go, like the International Monetary Fund has international data. The OECD has international data. The World Bank does as well. It's just terrific for putting that kind of data together. You can go to the Federal Reserve and you can get all that sort of stuff. I don't want to spend too much time talking about all this sort of stuff, but if you want to write about, if I could only share one website with you, it would be this one. So let me just see, what is the URL? Can you see it there? It's fred.stlouisfed.org. And there are tutorials. It's really easy to learn.
And then last question from me, and then we'll see if the fellows have any more questions. But what have you found is effective in trying to convey, monetary policy, big picture macroeconomics to readers in a way that they can digest and understand? I mean, I know your audience at the Journal is different than the audience of Metropolitan newspaper, but are there ways you can try to connect these big picture macroeconomic trends to what's kind of going on in people's lives?
So I would say a couple of things. First of all, I mean, yes, I work for a financial newspaper, so a lot of the readers of the Wall Street Journal are basically intrinsically interested in what the Federal Reserve is doing. So in some sense, I don't have to convince them to read an article about the Fed or read an article about the federal debt. They're automatically interested in that, and they'll come to the Wall Street Journal. But let's say you wanted to broaden that story out to a broader audience. Well, then the great Wall Street Journal tradition is that we use data like those tools I just shared with you to try and figure out what's going on with inflation, and then go and try and find out people who are living those trends. So you try and put faces to the trends that you're talking about, and you sort of explain why the world is changing in ways that is kind of new. So we've done a few articles on that mismatch piece. We had an anecdote about a guy who used to be an accountant, and he's unemployed. And he said, I can't work at Amazon. It's the wrong type of skill. So when you actually bring to the fore stories like that, it then illustrates exactly this mismatch. So one of like my sort of sayings is that economists always come up with some fancy word for saying something for which there's a perfectly good, you know, ordinary English expression for it. So economists like to say like, you know, mismatch and so on. It's just a fancy word for saying the workers and the jobs are in different places. So one of my jobs is to actually be a translator between, you know, what the economists are saying and what the ordinary American and the ordinary reader can understand. Part of the trick is to help the reader sort of like consume a lot of economics so them actually realizing at the end of the day that they were reading economics. If I wanted to get an ordinary person to read a story about the Federal Reserve, I might focus on the personalities involved. You know, Fed chairman like Jay Powell, before that Ben Bernanke, Janet Yellen, Alan Greenspan, they were very interesting individuals in their own right. And so we would often write a profile based on those individuals. International trade, you know, you would want to like go out in search of the single factor, the single consumer whose story kind of encapsulated all that. I was trying to think of a good example. I mentioned Domino's Pizza earlier in my conversation. When I was trying to write an article about how there was going to be a productivity revolution because of all the stuff that happened in the pandemic, I interviewed at length the head of information technology at Domino's Pizza, and he explained to me, yeah, all the different things they were doing to speed up the delivery of pizza. So that's really what it is. It's simply trying to find a way to translate those somewhat opaque economic concepts into things that ordinary people can understand. I like to say, if you can explain to your spouse or your parent or your kid who doesn't necessarily follow economics in their language why it matters, that's what you want to be able to do.
All right, it's all been very helpful. Fellows, any final questions for Greg? All right, Greg, well, I want to thank you very much for taking the time to come talk with us, and best of luck to you. And
Okay.
Fellows, we'll be on a break for 15 minutes, come back at 4 o'clock for the last session of the day. But Greg, I want to thank you very much.